Good morning, everybody, and welcome back to Money in the Law on my FM 101.3. The quest for the best is happening as we speak.
Yes, it is.
To be the greatest radio station, continue being the greatest radio station on all of the airwaves. And of course, this is Money in the Law. Is with you joined by.
I nominate you.
Yeah, we officially nominate you, my FM. Money in the Law is, of course, Jay Marsden from the Marsden Law Group. Joined by his esteemed colleague, that's me, John Drohan. I gave myself the esteemed from Main Effort Financial.
Whoop, whoop.
And we talk about all things that are involved with money and financial issues and answer financial questions you might have, as well as any legal questions and the law and understanding of the law. Particularly, one of the law things we particularly concentrate on is estate planning and elder law, which is my dear friend's speciality.
Oh, yeah. Right in the wheelhouse, baby.
Right
Yep,
in his
right
wheelhouse. And we're also joined once again by our dear friend Christian Bidet, who represents the House and Cable Access TV, who puts us on TV, and were it not for Christian,
puts us out into the cosmos,
we get to be on TV.
That's right.
And
That's right.
you know, I mean, some people, although you know most people listen to us on the radio, there are some people that tune in on TV, and
some people like the visual cues.
Well, and you know what I think they do? I think they'll listen to us on the radio, and then they, just like with anybody that you know, any radio personality, and then when you actually see them, you're like, that's not what I thought they looked like.
The old face for radio
yeah,
line?
Yeah, they're like, wow, you
Everyone
look
loves
different.
that one.
You look different than I thought. Of course, to Jay and I, they're pleasantly surprised. Oh, you know what? Those guys don't look as old as they sound.
Yeah, you sound a lot more rickety on the phone. Yeah. Things look
you sound a little more tattered.
Things look like
on
they
the phone.
hurt on the phone when you do things. Yep, that's right. That's right.
So before we started off today, before we began, we were talking about the big town meeting, and I got to see my pal. I just wanted to give a shout out to my pal, who got up at a town meeting on Monday night, and was back to his old self, just like he never left. Right? Got up in front and gave his point, and I was like, and I felt like I was on Money in the Law. I'm like, that's my boy, that's my guy up there. Listen to him go, right? Everybody else kind of talks a lot and gets, you know, they throw a few slides up. Not Jay. Jay gets up and says, here's what I'm talking about. Here's my point. Boom, boom. Settles it, and almost a mic drop. I mean, if you were holding a mic, it could have been a mic drop.
Yep. And they charged me for the mic. Broke the mic. There's a bill for the mic.
Yeah.
That's right.
And then someone's going to get mad at you, right? You know, like all the.
Well,
I
mean, it's funny when you're in law school, they tell you in law school, don't waste your words. Like you always have a certain amount of time to make your argument. You know, when you see. If you watch these legal shows, you know, when you see them, for example, when they argue in front of, let's say, either the Supreme Court or the state Supreme Court, and there's a series of lights in front of them, and the light comes on green, and it's go time, right? Yeah. And then yellow is like usually 30 seconds out, time to wrap it up, and then red is just like when you're driving, pump the brakes, you're all done, right? You're all done. Right? And so they really force you to sort of boil your argument down to its most base elements and make your point. Don't just blather on and on, right? Less is more. Less is more, you know. And
which is why our show is only an hour long.
It could be days. It could be days long, you know. But you see that a lot. Like I don't do a lot of court work. We don't do a lot of adversarial work at the Marsden Law Firm. It's all about making sure that all
the inside of a courtroom looks
all the teams look at the same. Where did the judge sit? Where's that guy sit? Right. So
do I stand up now?
But every once in a while it happens, and so sometimes and you see it at town meeting as well. A lot of times, you just kind of like let people go, right? Because a lot of people just don't. They think more is more, and so in a lot of cases you just sit back and you're like, I'm just going to let everybody do their thing, and they're going to kind of either talk themselves out, or they're going to talk themselves into a corner, or they're going to you just got to kind of like you just make your points.
Right. And the general rule of thumb is they give you 15 minutes, which is way too long.
Well, they gave you 15 minutes on that one particular article because they felt like the gravity of the article, warranted a little bit more, a little bit of a longer talking point. But you don't need all of it. You don't need all of it. Your points and by the way, not only can your points be made somewhat concisely, but in many cases, there's a lot of people making very similar arguments, right? So you always try to we used to, when I was on the board, we used to say to people, same thing. People would come into our different selectmen meetings and they'd have the same, you get 60 people in a room complaining about something and 59 of them would be saying the same exact thing. And you try to, in some respects, you try to be respectful and say, look, is there anybody here who has something different? Like I get I don't need 59, I don't like it, right? Like I know you don't like it, that's fine. is there anybody here who's got something different to say? Because we can move this along a little bit. Everybody doesn't have to get up and repeat the same talking
in the
points.
town meeting political system, though, that's kind of the beauty of it is people get to be heard. Right?
That's the legislature.
Right,
that is the legislature.
So that's the thing is that if somebody feels strongly about in their defense, they feel strong, they want to say something, and you know what? Oftentimes they'll end up saying what people in front of them have said.
And that's fine. Again, it's about being heard. You're exactly right. That's what the system's all about. It's all about being heard. That's right.
So,
that's
but then at the same time, and as you have experienced for your 9 years or plus on the board, where it's like these things can go. At some point they got to end. Like we gotta make a decision. We have to wrap this up and. If someone was, I got to say one more thing. I got to say one more thing, and then it drags it out to the point where where people lose interest.
Well, and so that's one of the things they teach you in law school, right? When you're researching for a case, for example, at some point you kind of keep tripping into the same cases over and over again because there's a method to the madness. When you see these videos of different law offices and law libraries, and there's all these books, and you think to yourself, "Holy moly!"
Who's reading them?
Who's reading them? But so there's a method to the madness in terms of how you do research and how you research cases and things like that. But that's what they tell you. Like, well, when does the research stop? That's what you always wonder as a baby law student. You're like, well, when do I stop doing the research? Because I don't want to miss anything. And that's what they tell you. They say, look, at some point,
and justly, you're afraid to miss something, right? You're like, I want to miss the. That's the key point. That's going to carry the day for me. But
that's right. And at some point, you do circle around to this. You keep seeing the same cases over and over again. That's usually when you say to yourself, all right, we've probably beat this thing to death a little bit. And that's kind of what you see in some of these arguments, town meeting, and some of the boards in town that hear things. You start to hear the same things over and over again. That's when you kind of say, all right, I think we've covered the ground on this. And let's figure out.
So
what
we
our
should
next
have.
steps are.
So there you go. I'm going to propose an article for the next town meeting that we should have at least one lawyer on the select board at all times. Is that a problem? Why would that be a problem, right?
No.
Which one of you guys is a lawyer, so you can kind of keep things, keep everybody on track, right? I don't know. I mean, I maybe if we expand it to 5, if we have 5 selectmen, maybe then more chances that somebody could be a lawyer.
Our current town administrator is doing a great job. He's doing a tremendous job. But before we had moved into when we were in the process of looking for another one, that was one of the things that, in my mind, I thought to myself, there's some value in terms of finding a lawyer who doesn't want to be a lawyer anymore, who wants to kind of move into some type of municipal government role, and maybe has some experience as a town council for another town or something like that, who's kind of looking to move out of the legal world. And for that reason, it's in some respects, it gives you a chance to be able to issue spots and things, and you look at things a little bit differently.
Well, you have a little more. You have training in it, right?
Yeah,
and that's the thing. You have training in kind of these open meetings. You have training in how and how to manage like a bunch of people who disagree. You know what I mean? There's that exposure to it where somebody who has never done that before, it can be a little bit overwhelming.
Well, you're on the lookout for landmines and things like that that could come up along the way that you don't think are going to come up along the way, and maybe you're not. You're kind of seeing it. So again, not that it's the end all be all, but it does help. It's a helpful background. But again, the guy that we have now does a tremendous job. Not taking anything away from him, but before we had him, and I wasn't involved in hiring him, but when we were thinking about having to find another future town administrator, I thought to myself, we might want to consider making that part of the process. And again, we get lucky and found a great one this time around, so that worked out well for us. But when we were crafting the background of what we thought we were going to be looking for, that was one of the things we added. But it's fascinating, and to your point, I mean, you want to see government and democracy in action, grassroots with nothing, no shine, no polish. You want to just see it in action. Town meeting is the place to go.
Go to your town meeting.
Yep.
Go to your select board meetings. Go to all your your committee meetings, and there it is. It's like that's what it's all about. I want to say something, and you're
well, not only and there's the details of the story are going to escape me, but I remember somebody if you're a history guy, right? You follow your history, and there was something that happened like hundreds of years ago when they were trying to do something around the Revolutionary War, where they were like they needed somebody's horse and oxen to help move some heavy equipment. I might have even been around like the George Washington, when they were the storming of Dorchester Heights and all that stuff.
I wish I had a few horse and oxen to move some stuff around.
But the story was that one of the guys involved in that type of incident, if you will, made sure that when his work was done after helping the Continental Army do whatever they did, he took the next 2 nights or whatever the time was to make it back to town because town meeting, town meeting, right? I mean that was like, I mean that's just like you see the movies, right, where they're all sitting around, passing judgment on each other, and that was the deal, right? You got to come back for town meeting.
You can only imagine that was, I mean, what else are you doing at night, right? You don't have electricity. It's not like you're watching TV or anything. So if there's a town meeting, right?
Something to do.
I mean, something really interesting to do.
Must-see TV back in 1784, right? Let's go, town meeting, let's go.
That's watching the presidential debate right there. We ain't missing that.
Put your Sunday best on. Let's get down to town hall. Let's pass some judgment.
Sports,
right?
Right.
That's right. That's a big deal.
That was an AFC championship game right there.
Yep. Get my good boots out. So that's it. So that was it. So it's a big week in the municipal world. Get a lot of the town's business done.
It was. I just had to say it was fun to see my old pal up and up taking his swings up there, looking good, feeling good. So it was
always fun.
It was good. It was good stuff. And also, I want to say that there may be somebody's father who I saw running around there too. So Mr. Bidet, your dad, I saw him running around.
Yep, director of traffic. Yep.
Director of traffic. I think he put somebody in a chokehold. Someone's giving him a little attitude.
Bounce him out.
He was kind of like the bouncer, right?
The enforcer. Yeah, that's right.
Do you have something to say? You better say it quick, right?
Yeah.
So good shout out to my old pal, Mr. KB. All right. So what do you got on the? Because I have an idea.
Something brewing over there. What's up?
So I was thinking about this, and oftentimes we'll talk about things and we'll say, and we'll kind of throw these out. Oh, so you should do this, you should do that, and we'll kind of throw some ideas and throw some concepts out that we just assume people are, they understand it. Because many people have done it before, many people have experience, but many people may not have experience. So one of the things I was thinking about saying, it's kind of come up in the practice, is the idea of refinancing, and then when you refinance a loan, particularly like your home loan, like your big loan. So the idea of refinancing and kind of, why people would refinance, and oftentimes people feel like, oh, it's a no-brainer, and I'm just going to refinance, and many people, as the interest rates have steadily been coming down for homeowners over the past almost probably 20 years,
forever,
right? Right, or even longer. Refinancing has become a very common thing. But one of the things is, like, when I talk to people about it, and it's funny because I make the assumption that, like, oh yeah, you've refinanced before, you know how to do this, and you know what's involved, because people be like, oh, I need to refinance, and I'm like, hold on a second, there's some factors.
Why? Yeah, let's talk about why.
There's some factors that are involved with refinance, and factors, with or even if you're purchasing, if you're buying a house and you're getting a loan that people don't understand about, like how the mortgage, how it works, and then particularly with the refi is why I'm going to do this and what's going to be my benefit of it. And oftentimes, people talk about, well, I'm going to extend out my loan. I only have 26 years left on my 30-year mortgage. I'm going to extend it back to 30, and we'll talk about kind of the pros and cons about what, when we coach people, and you as well probably, when we coach people, and you should refinance, or you should look at refinancing, or you should say look at it, but it's not going to be a no-brainer. So I want to talk about kind of the pull back the curtain on refinancing, and talk about how and why, and some of the details that often get overlooked in that system.
All right, we'll take a quick break. And then
Let's
we'll
take
come back
a quick
and we'll
break.
talk a little refi.
Yeah,
and,
we're gonna
we'll see where we go.
I
That's
mean,
exciting.
when in doubt, refi. No, that's not true. But
not in doubt. We'll find out. We'll find out in a minute if that's true.
All right. When we're going to refinance this segment of the show right after this, so don't go anywhere. We'll be right back. Stay here for Money in the Law.
And we're back. Money in the Law, MyFM 101.3. Jay Marsden with the Marsden Law Group, and John Drow here, Main Effort Financial. Christian steering us through the cosmos, and we are talking refinancing today. Good, bad, should you, shouldn't you? Who knows? I don't know. We're going to find out. We're going to find out.
And kind of what's the path? What's the what's the glide path for refinancing? Before we start, I want to give a quick shout out to my arch enemy, Erica Harich, who as many of you know, we're in the middle of old man softball season, much to Jay's chagrin. Every now and again, we're gonna talk about it. Old man softball. Downtown lost to Mudville 3-2 in 9 innings, which is I describe myself now as the worst player on the worst team. Nice. So I got nowhere to go but up. Nowhere to go. Yeah.
Go back and watch that game.
Yeah, go
on YouTube.
Go back. I don't know if it was televised, but it was
Legends of Old Man.
But the cool thing about it was on Mother's Day, and my mother came to visit. So
yeah, Janet.
So my mom came, and
last one out of the parking lot.
She showed. Actually, no. My mom's a fast visitor, right?
All right.
Even when she comes to the house, my mom, she likes to she's
in and out
under 24 hours.
There you go.
She comes in, does all this stuff. Everybody's happy to see her. She's happy to see everybody. And then in the morning, it's like I have to say, listen, you can't leave before the kids leave, right? Your car is parked, like the cars aren't right. So she's got to get back on the road and get home.
All right.
So all right. So let's talk about refi. All right.
So just real quick, refinancing basically means taking a loan that you've already received.
Yep.
Right. And basically redoing the terms. Right. You have a 30-year mortgage that you got 5 years ago. You're 5 years into your 30-year mortgage, and for some reason you sit down and say, I want to do this all over again. I want to reset the table. I basically want to reborrow the money, and I hopefully am reborrowing it at either a better rate. So I had a 4% mortgage, now I want to have a 2% mortgage. I want to pay less on the money I borrowed, or I want to refinance it for time. I had a 30-year mortgage, now I want to have a 20-year mortgage or a 15-year mortgage, whatever it is. That's what we're talking about.
So in the idea of, one of the big things with refinance and first and foremost is we always consider like real estate loans or mortgage loans, for the most part, they're good. That's good debt.
Yeah, it's not credit card debt. Yeah, it's good loan.
We look at that as good debt. So and with the way the tax laws are set up, as long as you can up to $10,000, if you pay interest up to $10,000, you can deduct that from your income taxes, which is a great tax benefit. One of the things is that we look at particularly with refinancing is, or when we look at these loans is they're a constant cost. They're a cost that you're going to have, and oftentimes it's like your biggest cost, like the biggest cost that you have, for your monthly budget. So our big thing is really cash flow. So first and foremost, as with anything, I love the idea of maintaining, we always want to maintain a positive cash flow.
Sure.
So in the idea of refinancing, when it comes up, and you brought up the thing, why am I going to refinance? Well, you might refinance because there's an opportunity to do so. You also may refinance because you have to, right? Whether there's an opportunity, you might kind of be forced to, because you may need to take some money out of your house. You may need to do something, something where you need to change that loan. Potentially the loan is not a fixed rate mortgage. It could be a variable rate mortgage. But first and foremost, the idea is that you're going to refinance because there's a better opportunity. So and in most cases it's a lower interest rate. And as we were talking before, the interest rates have been coming down for the last over 20 years. They've kind of steadily, it's not like
they pop up, they pop down, but they've been on the downswing. Yep.
Yeah. When we bought our house, back 20 years ago, and I was psyched to get my 8.5%.
That was my first mortgage was 8.8 in Charlestown.
Yeah, 30-year loan, and that was because you talk to my old man and you talk to your dad, and they'd be like, that's nothing, right? I paid, I was paying 16.5%. I was refinancing to get to that. Yeah. So. Those old days of like crazy, interest rates, when for the mortgages was, that's a thing of the past. But, at the end of the day, we're going to refinance. We'll coach somebody to refinance if they have a potential to have a better rate, right? If they have a better rate, and oftentimes if I'm going to get a better rate, then it's going to result in having an effect on my cash flow.
And again, just so people understand this. So when if you pay $350,000 for your house, and then you mortgage your house, and it takes you 30 years to pay it off, the company is going to tell you when you do your mortgage, you paid $350 for the house, but with all your interest over 30 years, here's what you're really going to pay on your house, right? Some astronomical amount. So what you're doing is you're taking that astronomical number that's in addition to what you paid for the house, and you're putting that number lower. Yeah. You're making that number less than what you originally had. So if you borrow the money at 4, it's better to borrow it at 2. That's the idea.
Yeah. So like as I said, the first rule is cash flow. That's usually what's going to carry the day for me, because the idea of, and you bring up a great point. The idea of, okay, so if I finance a house over 30 years, and I look at how much interest I'm going to pay. People are like, often that's a staggering number. Like, oh my God, I can't believe
it's almost enough to make you not buy a house.
Yeah, and you're like, oh, I feel like I'm wasting money. But at the end, but what we say is like, look, in order to live in this house, you don't have $350,000 sitting in the bank in order to pay. And if you did, and if you had the flexibility to do that, then we may say, hey, you know what?
There still might be an argument to borrow the money.
There might be a great argument to borrow
Yeah.
the money. So now, like in these low interest rate, in our low interest rate environment, and you have the opportunity. Let's say Jay used the example. I can go 4 to 2. That's a big jump. So let's say 4 to 3, right?
Sure.
So let's say.
Yeah.
So you're currently have a 30-year loan at 4%, and you can drop it to 3%. What does that translate to? So the first thing you look at is the size of the loan. So let's say your loan is $300,000. So, and I don't have the mortgage numbers in front of me.
Right, we'll make it up. Yeah.
Yeah. So if my mortgage for $300,000 is at 4%, and I can refinance that for a 30-year loan to 3%, then that's going to change the cost. It's going to change the cost significantly. It could be something to the tune of probably over $200 a month.
Yep.
Right. So that's the first thing you look at. You're like, okay, well now, remember, my cash flow is my mortgage, my utilities, my cost of my food, the cost of my whole cost. That's our big numbers. How much does it cost for us to live every month? And if I can change that by $200 by doing nothing other than restructuring my loan or getting a new loan, we've said that how many times we said this on the show. I've just manufactured $200 a month.
Yeah, it's almost free money.
Yep, I've manufactured now. So the idea of, okay, well, that's a 30-year loan. Let's say we said the example before. Let's say if we're 26, we're 4 years into a 30-year loan.
Sure.
And then you say, well, if I refinance back to 30, then I've added another 4 years to my loan, but I'm still saving my $200 a month. Why would you or would you not do that?
I wouldn't do it if, depending on my age, depending on what my game plan was for retirement, if my goal was to have my house paid off in 25 years, for example, and if I'm going to restart that back to 30, and I was going to retire in 25, so I was trying to line up, my retirement and my mortgage being paid off, I might not refinance.
Yep.
I might say, well, I'm going to pass on the refinance. I know it'll save me a couple of bucks, but I don't want to go beyond that 5-year window. I want all that buttoned up at the same time. That's one option. The other option would be you wouldn't do it, but you'd still do it if you thought to yourself, look, the amount of money you're going to save and the interest by doing this is more than what you're going to get out of the longer term refi, and you're going to still put money on the table, and it's a better deal. And let's do something with the 200, right? This is the other thing. Let's not blow the 200 on, whatever. Let's invest it. Let's do something with it, and let's kind of bridge that gap a little bit. So from flexibility perspective, that's why I would do it.
So remember in the old days where you used to not be able, you could get a 30-year loan or like a 15 or 20-year loan or a 15-year loan. And now the mortgage companies or the banks have enabled you can get any mortgage.
Sure.
You can refinance.
Any denomination.
Yeah. So if you want to refinance let's say you're 4 years into a loan, you can refinance that loan for a 26-year. They'll amortize it out for 26 years. So you have that option. So let's say you did that. So let's say you're looking at a loan and you're 4 years into it and you amortize, and instead of getting a 30-year loan, you get a 26-year loan. You may still be saving money, right? You may, and in fact, you probably will be still be saving money. But now your loan is identical. You're not any further. You're not setting yourself back.
Right, you're not restarting the clock, which is what which is why people are reluctant to do it.
That's right. So and that's a big stumbling block we find with clients is they're like, oh, I don't want to go back. I don't want to go back.
Yeah.
I don't want to. I want to go back in time because I feel like I'm on my way. And I agree with that. I agree with that, especially if you're close, right? Especially if you're. So some people, like, let's say they're 10 years into a 30-year loan, right?
Sure.
So that's usually kind of the rule of thumb. Like if I'm 10 years into a 30-year loan, and then I go to refinance, do I want to refinance out for another 30 years?
And the reason people are reluctant is in the beginning of your loan, all your payments basically go towards your interest.
That's a great point.
You're not
right?
chipping away your principal.
So the idea is now so why would somebody do that? And here's a good example. So again, it all comes back to cash flow. So let's say if I'm 10 years into a loan, and it's a good size loan. Let's say it's like $500,000 loan. I'm 10 years into it, and then I can refinance from say 4% to 3%, or say or a little bit lower. and I'm saving a considerable amount of money
Sure.
between my first mortgage and my refinance. So let's say I'm saving, and for me it would have to be a big amount. It would have to be kind of north of $500,
Sure.
maybe more. So then you can do the math on it, and you could say, look, you're going to save per month. You've just manufactured $500 a month.
Yeah, that's real money.
Yep, $500 a month. And the other question I ask is you say, okay, why would somebody do that? And a good answer would be, I don't think we're going to stay in this house.
Good
right?
point. Yep. Excellent point.
So if they say, because that's the next, I'm like, do you?
Well, because refinancing can cost you some money, right? There's closing costs. We'll
get to that.
Yeah, okay.
Yeah, we'll definitely get to that.
But that's why it's part of the analysis.
Yeah. So someone may say, well, we don't think we're going to stay in this house, and so at some point we're going to sell it, and we're going to sell it within the next 20 years, right? So kind of the knee-jerk reaction would be, well, why don't you just refinance at the lower rate for a 20-year loan instead of 30?
Right.
And if I do that, I may not be saving any cash flow money. I may be paying the same amount of money, or maybe saving a little bit of money, but now my loan's only 20 years.
Right.
And then what Jay brought up a great point is how the way these loans work is that the interest is kind of front loaded in the beginning. So you're not really chipping away as much of the principal until you get later on down in the road, or longer along in the loan. But my argument would be, look, if I can save big money right now, and I know I'm not going to stay in this house, then really what am I doing is, all I'm doing is I'm buying time. I'm buying time. It's not like I have any, I'm going to have any, it's not like I'm adding principal to my loan.
Right.
So now I've I've freed up $500 a month, and I can do something, like Jay said, I can invest it. I can invest that towards my retirement. Maybe I can use it to help pay for my kids for college, or save for my kids for college. But I know that I'm not going to stay in this house. So when I sell this house, whatever I owe on it, if I owe $500,000, if I owe $460,000, that's not going to be a huge, you know how real estate works. Like, it could be, real estate, the value of real estate changes, the way the wind blows.
Sure. Yeah.
So at that point, you'd say, look, I've saved $500 a month for the last, for the next 5 or 6 years. I know I'm going to sell my house, and when I sell it, I get what I get for it. But in the meantime, I've manufactured $6,000 a year for the last 5 years. That's real money, right? That's real money. And the other thing is, cash flow is a big deal. Cash flow, having enough money at the end of the month is, that's a big like psychological thing.
Well, having enough, and then on top of it, having more, right?
Yep.
Having the ability to say, look, we're going to take that $500 that we were getting out of it and save it, and we're going to do something with it. We're going to invest it, do whatever we're going to do with it. That's a huge deal.
All right, so we're going to take a quick break, and we're going to come back, and we're going to talk about some of the other factors with refinancing, which is a big one, which is closing costs. One of my favorite topics of refinancing is closing costs, because you and I have dealt with mortgage guys, right? We know them, and I know a lot of wonderful mortgage people, but remember back in the day when it was just like, everybody, it seemed like every fifth person was selling a mortgage.
Well, that's what happens when you usually become a mortgage guy because somebody owns a mortgage company.
Yeah.
And then their brother or sister-in-law or uncle is also an attorney who just happens to just do house closings.
Yeah.
Right. So there's this
What
whole
do
internal.
we got it. We got a
that's
system right here. Yeah, we got a system. So we're going to talk about that right after this break. So don't go away. My FM 101.3. Quest for the best. Quest for the best show. This is Money in the Law. We'll be right back.
Right back.
I'm just saying.
And we're back. Money in the Law, My FM. Just kidding around. And we're back. Money in the Law,
Yeah,
My
we're
FM.
back, Jack.
101.3. Jay Marsden, Marsden Law Group. John Drow here, Minute for Financial. Christian. Caught him by surprise behind the camera there. Chit-chat with you about societal climbing and the ladder.
Guess what?
What?
Guess whose birthday was last week? Christian Bidet.
How old?
Christian Bidet.
27.
27. He is. You remember being 27?
That's a half a lifetime ago.
Oh, that was a good year. Like, right?
I don't remember most of it.
Bulletproof.
I don't remember most of it.
Nope. You know what? You were running and gunning like Christian is, right?
Yeah.
His hair on fire.
Living in town, working at that small mutual fund company.
Right.
Just getting after it. Yeah, it's all good.
20. So happy birthday to our
Happy
pal.
birthday,
Sorry we
Christian.
missed it last week. In the break we were talking about it. I was trying to, like I said, I was trying to, because Christian's brother, what's your brother's name? You can't say. He can't talk.
say.
Right? You know what?
Doesn't matter.
Give us
Doesn't
the
matter.
hand and arm
Doesn't
signal.
matter.
We're going to make up a name. We're going to call him Doug.
Mr.
all right?
Bidet.
Yeah. Right. So his code name is Doug Bidet. He's getting married, and the rumor is they are looking for people to go to the wedding. So I was like, we're
done and done.
Yeah,
Who's better than us?
we're more than happy to work.
Celebrity wedding appearance by us. Fantastic.
Yeah,
That's great. Hopefully, by the way, we only go if we're at the head table.
Yeah. I don't think we're invited to this.
You know, yeah, that's right. I mean, hey, last time I went to a wedding, I got married. So, you know, you got to be careful when you go to a wedding. You never know what happens, you know?
I'm telling you, maybe
watch out.
that might not be a bad market for us, right? Just to be there.
What kind of market?
Again,
What do we?
It's not. It's
make
not.
sure we're talking about what market are we talking about?
It's not wedding crashers.
No.
It's like more wedding enhancers.
That's right. Bingo.
Yeah, we're
bingo.
there.
Love
you
it.
know, because you and I, we do okay. We can we can meet people.
We can wheel and deal. We can wheel and deal.
We're not going to sell you any product. Right?
That's right.
There's no sales or anything like that. We don't even necessarily have to talk about money or the law.
We didn't even have to stay for the whole wedding. We stay for the whole wedding.
Most of the time, we won't.
Yeah, I was in Orlando a couple weeks ago for a work conference, and I tried this strategy of a wedding enhancer, and they saw us coming a mile away, and they decided that they didn't want us to attend the wedding, and I said, maybe we shouldn't have gone right to the bar. Maybe we should have mingled a little bit. But all right, here we are.
You're not on the list.
Here we are. That's right. Here we are. So,
it is one of my favorite movies of all time. Is Wedding Crashers.
Classic.
Yeah,
Classic.
In fact, I think every time I watch it, I call you afterwards.
Yeah. Well, it's on TBS about 10 times a week, so why wouldn't you watch it?
What are we doing?
So great.
So happy birthday, Christian. Sorry we missed it. We'll be more attentive next time.
Next year. We're 30.
All right. So we were talking about refinancing and some of the, the strategies and the ideas behind refinancing. And the first one we said is of course if I can refinance to improve my cash flow, and I can stay within relatively the same amount of time for that I had on my loan, then that's great. Then it's almost like, well, okay, what's the other factor that I have to take into consideration? And the other big factor is the closing cost.
Oh yeah.
Right. So in order to because everybody's got to get paid, right? So you've heard all these, well, you can refinance with this bank or with this mortgage company, no points, no closing. How many times have you heard that? So that means what they're saying is that all you're going to do is you're going to change your rate from 3% to 2% or 4% to 3%, and it's going to cost you nothing. And you say, why wouldn't I do that?
I love free. Who doesn't love free?
Why wouldn't
I do that?
Yeah. Now, understand that because nothing in this world is free, your refinance that you are getting for no points, no closing, is in fact not free.
Correct.
Right?
You'll be shocked to hear.
Yeah. So whenever anybody says, hey, I'm going to refinance, or if I refer somebody and say, hey, I want you to talk to this mortgage person or talk to this bank, I really think you should look at refinancing, I always say to them, what you need to do is you need to have the mortgage person in third grade English explain to you what the closing costs are.
That's right. Because there will be some.
And write them down. There absolutely will always be closing costs.
That's right.
Now, there may not be when they say, no points, no closing, they may say, well, there's no closing costs for the particular mortgage company.
Right.
But that doesn't necessarily
And just so everybody knows, a point is basically money that you pay to the mortgage company to get a lower rate.
That's right.
All right. You're giving them money. It's a formula. We won't get into the details. But you can go to the mortgage company, and the mortgage company will say, you're using John's example earlier, your rate is 3%, but if you give us some money, we can make it 2.8%, right? Because now they're going to give you a lower rate, so that they're going to earn less money, so they'll take a cash payout, basically, to get you into a lower rate. So you get a no points loan, you're not going to have to come out of the pocket for any money to get the 3% loan.
That's right. So the important thing is that the mortgage company is going to get paid, and they get paid one of two ways. They get paid either by you paying it.
Paying them an origination fee for giving them the mortgage.
Paying them a fee.
Mortgage, and
usually that could be anywhere from $2 to $3 to $4, depending on the side of the loan, but it could be several $1,000s, right? And then there's other costs that are involved. There's the title search costs.
Yes.
There's an appraisal cost, and there's several other costs. There could be an attorney fee. There could be this is Jay could probably explain this much better than me. There's all these lawyer fees that get involved. I mean, not all these, but there are other fees.
All the right ones for all the right reasons.
All the right ones, and usually they're very low and very reasonable.
That's right. So totally, yeah.
But there's probably several other costs that are involved, and that makes up the closing costs. Now, when a mortgage company says we're not going to charge you the closing costs, we're going to waive our $2,500 or $3,000 fee. The other fees are still going to apply, so they're going to be there, but you may be saving this 2 or 3, and you may say, wow, that's great. Why would a mortgage company do that? And the reason is because they get paid on, the second way a mortgage company gets paid or a bank gets paid is on the rate. So if you're refinancing from, and Jay gave a good example, if you're refinancing from 4 to 3%, they may say, hey, no points, no closing. You can get a 30-year loan at 3%.
Because, by the way, if you're not a client with them, they're making 0%.
Yeah.
Right. That's right. That's right.
So you can go from 4 to 3%, and you're like, okay, that sounds great.
Sure.
But the reason that they're offering you that 3% is because really the going rate at that time, a rate, if you went to perhaps another mortgage company, you may get a 2.5%.
Right.
So you may get a better rate, but because the mortgage company can escalate the rate and sell it to you at a higher rate, they're going to make up their fee, and that's where that fee comes from.
They're borrowing that money at one rate, they're offering it to you at another rate. There's some cushion built in there, and that's how they make their money.
That's how banks make their money. So, sometimes, when someone says no points, no closing, like, well, why wouldn't I do that? Many times that could be a good deal. However, if you may go, that's why we always tell people to kind of shop these rates out, shop your mortgages out to other lenders. You could go to another lender, and the other lender say, yeah, $3,500 closing costs. However, what's your rate? Your rate is 2.5%. And then you say, well, wow, that's a different rate. That's going to cause that my cost per month is going to be less.
Right. And
my overall, the amount of interest that I pay over the life of the loan is potentially going to be less. But it's going to cost me this upfront cost. And oftentimes these loans, when you refinance a loan, it may be in your best interest to add the whole mortgage cost, the closing cost, into your loan. Sometimes people refinance and they'll just lump that cost.
They basically borrow the cost of all those costs, right?
Yeah.
They roll that into their mortgage. You wanted to borrow $300,000, your closing costs are another $5,000. They borrow $305,000 at this new rate, then they have to come out of pocket with any money.
And that sometimes feels good, instead of writing a $5,000 or $5,000 check.
But you bring up an excellent point. The thing to keep in mind is when you refinance your mortgage, yes, you're refinancing your mortgage, but you're basically getting another mortgage.
Yeah,
right?
you're getting a new loan.
You're getting a new loan. And so when you get a new loan, all your old stuff, in many cases, doesn't carry over. So the reason I bring this up is because if you're trying to refinance because cash flow is a challenge for any number of reasons, when you get to the point where you're going to actually go to your closing, you may get a bill. You may get a number when you go. I mean, think about when you got your first mortgage, right? When you got your mortgage, the mortgage company, the closing attorney said, oh, and by the way, you're getting a $300,000 mortgage. That's the money that we're getting from the mortgage company. But you need to bring a check made payable to. Maybe it's a bank check, maybe it's a personal check. But you had to come in with money for things like recording fees, discharge fees, overnight costs. You had to come up with some new escrow money because they were taking your insurance out of your mortgage. And so you're getting your new mortgage. Some of this money you'll get back, but you need to understand going into this, you may have to come up with a couple of grand.
Yep.
And I'm not saying that you hold back and don't do it because of that. We get these calls from time to time. We get these panicked calls from somebody who says, I thought I was doing this mortgage and the broker told me it wasn't going to cost me anything. And the answer is, it's not costing you anything, but you have to come up with some of these costs that are just related to you owning a home.
It is costing you something, right?
That's right. Well, it's not costing you anything for the mortgage, but you got to come up and you got to if you paid if you're halfway into a 1-year homeowners insurance policy,
right,
and you go with a new homeowners insurance policy because you're getting a new mortgage. If you paid $1,200 for the homeowners policy, you're going to have to come up with the other $6, and then you're going to get the $6 back. So there's some money movement here. And you got to be able to or be prepared to come up with something to cover these closing costs that, although they might not technically be closing costs, they are expenses related to your closing just because you're kind of resetting the stage of who's carrying your mortgage and who's doing what. And it's sometimes the banks rely on the fact that you don't want to go through the gymnastics of moving your mortgage because it can be work, right? It can be work. So.
And it's got to be worth it, right?
It has to be worth it. And just be prepared for this idea that don't be lulled into this sense of complacency that they told me it's not going to cost me anything, that you're not going to be expected, even if it's $1,000 for any number of reasons, just ancillary miscellaneous costs. Those aren't the costs related to the mortgage. That's just you kind of getting your loan settled into another easy chair, right? Because I had this loan over here and everything was going great and everything was on autopilot and I have to worry about it. So I'm kind of upsetting the apple cart and moving it over here. So until that gets going, you're going to potentially have to cough up some dough. You'll get some of it back. Just don't let it catch you by surprise, because it can.
Which is why I love the lenders who dumb that all down for you.
Yeah.
And I love it when they say, and I know many of them, right? And where they're like, okay, here's how much it's going to cost. And they tell you up front, they're like, you're going to pay me, you're going to pay my company in order to do this loan. Or you're not going to pay my company because we're going to get paid on this rate.
Somewhere.
You know, right? And you know, they're all salespeople and they're trying to, you know, sell business for their, and they may say, look, you may be able to get this a better rate, but the rate's not going to be, it's not going to be that much of a different rate, right? It may be like, you know, Jay gave an example, like a 0.2% rate or something where, you know, at the end of the day, you're like, it's not going to, it's going to change my payment from, let's say my payment is $1,800 a month versus $1,812 a month.
Right.
You may be like, it's not worth it to me, right? It's not, you know.
It might not be.
Even if I do the math, right? This may be cleaner, but the idea of where, and then they say all those costs of Jay, they list them all and say, here's what's going to happen when you go and close this loan. And if you go there and that happens and you have your expectations of what's going to happen, then you're happy, right? And then you're psyched.
Now we get just real quick on the law side. We get phone calls a fair amount from people who want to refinance their mortgage, and they say, look, Jay, you know, we want to help you. We want to hire you to help us with the refinance of the loan. Now, remember, when you hire an attorney because you're buying a house, there's going to be some things that happen between you and the seller, right? That's a two-party transaction. The bank is involved, so there's really three parties at the table. But there's potentially there's the potential for some type of sort of adversarial relationship, meaning the sellers want to leave behind, you know, the old paint cans and some old pool equipment and some old landscaping stuff that I don't want, right?
Yeah.
And the buyers are saying, I want that taken care of that. I want that. So there's some potential for the sellers and the buyers to be kind of at odds a little bit. When you're getting a mortgage as part of a refinance, it's just a transaction between you and the bank. And so people will ask, you know, do we need to get involved as the lawyers? And my answer to them usually is, there's not a lot that we can do, right? Because the banks basically operate off of the idea of, here's the paperwork that we want you to fill out, right? And somebody will say to me, Jay, I want you to read through all this paperwork. It's a fairly sizable stack of paper, right? So if you're trying to keep your costs down, you know, hiring us to read this at $3.35 an hour.
Slow. He reads but that mortgage is very slow.
You know, we want to be very thorough. We want to be very thorough. That may not necessarily
12 hours to read.
Be a great option. We do the math on that. But what I usually tell people is, unfortunately, if you want the big check, right? You got to kind of, the bank sort of makes the rules, right? The bank makes the rules. What's the joke? If you owe the bank $500,000, that's your problem. You owe the bank $500 million, that's their problem, right? So this is a loan. This is the bank is going to say, look, it's a take it or leave it thing. You know, you don't get to opt in, you don't get to opt out. If you're not that client at the bank, the paperwork is the paperwork is the paperwork, right? They're going to give you a closing disclosure. It's going to tell you what your expenses are. It's going to tell you where your out-of-pocket costs are going to come from. That's their disclosure requirement so that you know what you're paying for. All of that other stuff, it's just in there. I mean, we certainly can look through it for somebody if we want to, but we usually tell people, look, that's the deal. The bank is their money, and you gotta, you know, if you want it and you don't have the ability to dictate terms, you're going to get what you get. You know, you just want to know what you're going into.
And in light of the, you know, in kind of the post 2008, you know, real estate and bank collapse, the banks have tightened their shot group quite a bit on how this works. So in the old days, it used to be like, you know, they were making it up as they go along. Now, you know, the government kind of bailed all those guys out, most of them.
I'm not saying it's not worth it. I'm just saying that's kind of how we approach it, which is, look, that, you know, unless you're doing something that's really customized and really hinky and really coming at it from a completely different angle, and it's these, you know, they have a set of closing documents that they issue day after day after day.
Yeah, a straightforward refinance is pretty straightforward.
There's not a lot of moving parts to it. There's not a lot of moving parts to it. So keep in mind.
Yeah. So the one other thing is, you know, again, we discussed the closing costs. So the other part of, you know, the other thing that we take into consideration when we talk about refinancing is the idea of, and we touched on this earlier, is like the length of the loan. So, you know, how, you know, is this going to be, and I guess the question is this going to be the last loan that you have on this house, right?
Yeah.
And if it's a 30-year loan, so let's say you're 50 years old and you're refinancing for a 30-year loan, are you going to keep this loan for 30 years? You may keep the loan, but you may not keep it for 30 years. And again, everybody wants to own their house, and that's a common feel. I want to own my house.
Yeah, put all the numbers aside. Yeah. We're not going to number this thing up. We're not going to sharpen the pencil on this. To John's point, most people at the end of the day will tell you, I want to own my house. Yeah. How they get there, hook up by crook, they don't care. They just want to own their house. You can tell them all the ways it makes sense to keep refinancing the daylights out of this thing, and they won't do it. They want to own their house.
Yeah, but there's going to come a point in time where, if cash flow is good and they have money in the bank and they have the ability, they have a retirement, I have a retirement strategy to be able to retire.
Sure.
Owning your house and not having that mortgage payment or not having that debt anymore, that may be a significant part of that retirement strategy. So when we get to this point, oftentimes we get to this point where, especially with like the clients that are, that have been in their house for a while, and with the interest rates coming down, they may say, and my mom's a good example. So my mom, we refinanced her loan to a 10-year loan, and this was back, she had a 30-year loan. She was paying down on, and then she went from, and I forget what the payments were, I forget what the numbers were, but we went from a 30-year loan to a 10-year loan.
Sure.
And that increased her, so we talked about cash flow, so it increased her cost, right? Yep. So her cost was now, instead of paying $2,500 a month, she was paying $3,500 a month. So a $1,000 increase in cash flow. Now, why would somebody do that? Well, for two reasons. One is because you can afford it, right? Yep. You can afford it, and now I've taken anywhere from 20 to 15 to 10 years off the back end of my loan,
yeah.
And because that interest rate is a very good rate. So and this came about probably within the last 4 or 5 years when these shorter loans, these smaller loans, in order for banks to sell them, they had to have really, really low interest rates. So you're talking about under 3% for an interest rate, and it's a 10-year loan. So at that point, when we say, well, is this going to be the last loan? That's the last loan.
Well, that's right. And the other thing we've talked a lot about cash flow, and you just gave a very good example of, you can change the terms of your loan, and if you're comfortable with the amount of money you're paying, you could segue into a lower loan payment and just keep paying the same exact amount of money that you've been paying.
Right, and so that's where I was getting to next. It's almost like yeah. So oftentimes, because people be like, and they'll see this. They'll say, I can lower my rate and I can lower my term. And again, it all comes back to that mindset of, I want to own my house. And now, if I'm in a 10-year loan, I can see the barn. Like I'm like, okay, I'm 55 now. When I'm 65, this is going to be gone. I'm not going to have a mortgage payment. I've had a mortgage payment my whole entire adult life, and now I'm not going to have that anymore. And that's a huge, that's a big feeling. And financially, it's great, but it's also like emotionally and psychologically.
Well, if your mortgage is $2,500 a month, you got to make like $65,000 a year to pay that off after taxes. So it's a huge win.
So that changes your retirement dynamic. So we get to this point where people are like, they see that, they say, well, I can refinance to a lower, and still pay the same or maybe pay a little bit more. Or if I refinance all the way back to a 30-year loan, then I'm like, oh my God, I'm going back to 30-year loan, but I'm saving $400 a month or $500 a month. And then depending upon the rate, depending upon the situation, I may say 30-year loan. And they're like, what? Are you out of your mind? Why on God's green earth? And I'll say 30-year loan. And here's why. You owe $200,000 on your house. You are now going to save $500 a month by refinancing, whatever is left in your loan all the way out to 30 years. Guess what? That 30-year loan, you're not going to have that 30-year loan for 30 years.
No.
You won't. But guess what? For the next 3 years, while you have 3 kids in college, and your cash flow is like super tight, you're going to pay whatever the mortgage payment is on that loan.
Right, the minimum payment.
Yep, you're going to save your $500. You're going to save $500 a month. You're going to pay the minimum payment. And then guess what? When all 3 of those kids are out of school, and all of a sudden you have, I'm not paying for college anymore, guess what we're going to do? We're not going to refinance the loan because we got a really good rate on this 30-year loan. And guess what 30-year loans don't do? They don't charge you anything to pay them off sooner.
That's right. Pay off more.
So to Jay's point, because he studied for the quiz, is we're gonna pay more on that loan if that's the plan.
If it makes sense. If it makes sense.
If that's the plan that we want it, that we're going to pay this loan down to get it to a certain.
And then to your point, you get jammed up. Not every month, but you get jammed up 1 month, 2 months. Sometimes you get jammed up. Something goes up. You say you want to get a car. You say to yourself, you know what I'm going to do? I'm going to go back to the minimum payment for a little bit. Don't forget about it. And I'm going to bring it back. And I'm going to keep overpaying on the loan. And that will get me to a 28, 27, 26, 22, 19, some crazy number. That's not 30 years.
And that's the huge thing, and we talk about it all the time, is it maintains your flexibility to be able to do it. So
flexibility.
Maybe you can't, and maybe there'll be some times when you can, but like with any loan, especially, and we see this like a lot with student loans too, you're going to get to a point where you're like, okay, I owe $52,000 on this loan, and I have plenty of money in the bank, I have plenty of retirement money, and guess what? You know what? I'm paying it off.
Yep.
And you're like, whoa, but you can and you're like, nope, I'm paying it off because I can afford it. It's not going to change anything. I'm paying it off, done.
Let's do it. All right.
All right, so you go pay off your loan.
I'll go pay mine off right now.
Pay mine on if you want. You
got
pay,
it.
Yeah, we'll pay them both. Christian,
You're
living at home right now. You could help us pay off our loans.
You can pay parents off. That'd be psyched.
Help them out. Yeah, give them a hand. Right. All right. We're done.
We're done.
Yeah, we're done.
All right, everybody. If you need any questions answered about refinancing, email the show, moneylaw.net. Happy to answer them on air. All confidences will be kept if we feel
we'll make up names for you.
If we feel like doing that,
yeah.
And we'll be good to go.
All right, we'll see everybody next week. Thanks for
joining
us. Money in the Law.
Rock
My
on.
FM. Crush of the best.